Hi, I'm Halstead, Associate Director at L&B, the charity division of Cantor Fitzgerald, Ireland. We've specialised in providing ESG or environmental, social and governance screened portfolios to charities and businesses for over 30 years. I'm here today to tell you about 3 critical long-term trends in markets that all investors should be factoring into their investment portfolios. First, our specialty is climate adaptation, and though it feels everywhere at the moment, is only just beginning and much more will be required to meet the climate challenge. Second, inflation. Again, it feels everywhere, but is making an unwelcome return after 40 years. And lastly, growth. The world economy looks set to continue to endure persistently low economic growth. This has been a feature of the last decade, but due to structural factors woven into the fabric of the global economy, looks set to persist for the next decade as well. So looking at the climate transition first, as we know, the world is heating at an alarming rate. Each decade is hotter than the last, and this chart shows how temperatures are reaching an average of 0.8 degrees over pre-industrial times in the last decade. We may have already reached 1 degree rise in the last year or so. Put another way, this chart compares average temperatures each year versus the average over the last 200 years in total. And you'll see that almost all of the above average temperature years occurred in the last 50 years or so. The direction of travel of this chart is very concerning. The trend is rising, as you can see, but also it looks to be accelerating, which is very disturbing. The good news is that the world has noticed what's going on and is taking action to reduce carbon emissions from the current rate of 50 gigatons per annum. A gigaton, certainly for me, is not something I've come across particularly often in daily life. So for reference and to provide a lens through which to view it, a gigaton is 1 billion tons or 1 trillion kilograms or 2 trillion pounds weight for those who prefer the imperial measure. It's roughly equivalent to the mass of all land mammals other than humans on the planet, or 2,000 fully loaded oil supertankers. And if we were to fill Central Park in the US with ice of 1 gigaton weight, it would be higher than all but the tallest buildings in New York City. So the current CO2 emissions equate to 50 of these blocks of ice every year. So it's a little wonder that the Earth is warming and struggling to absorb this amount of carbon that's being emitted. This chart shows how emissions are likely to progress over the remainder of this century. Under current policies, we're still emitting 40 gigatons of carbon per annum by the end of the century. And that's consistent with a near 3 degree rise in global temperatures. Only if governments and companies meet their pledges and targets do we get to a 2 degree rise, which is still very serious and won't be a comfortable world to live in, but it will be a livable world. And only under more optimistic targets do we get to a more sustainable future. So in order to address climate change, the investment needed will be truly staggering. According to McKinsey, we need a total investment of 275 trillion with a T or by 2050 to achieve net zero. It's a total of 9.2 trillion per annum and an increase of 3.5 trillion over current spending on physical assets. For a frame of reference, it's equivalent to half of all global corporate profits, 1/4 of the total tax take of governments around the world, and 7% of household spending. So the private sector must help with the heavy lifting. But the negative effects of climate change will be far more expensive in terms of cost to mitigate and human suffering. So irrespective of whether we think that climate change is the greatest issue that's facing our species or a complete hoax, the huge investment required will have a major impact on investment markets and your investment portfolio. If there's any doubt as to where we will seek to prioritise climate change or whether we will actually be looking at climate change relative to all the things we need to spend money on as well in the future, it is useful to ask the following question. What do you think the worst effects of climate change actually are? I'd imagine some of you may answer forest wildfires, which are currently spreading all over Europe. Some of you may think of increases in hurricanes or storms as we enter hurricane season in the US. Some of you might think of desertification and drought, again plaguing Europe. Or indeed some may think of rising sea levels. This video shows the effect of rising temperatures and sea levels in Florida, for example. It's a very sobering view for anyone with property or loved ones in that state. Or if you need an example closer to home, we can see here the effects of runaway climate change on Dublin in these charts, which makes for pretty sobering viewing. At 1.5 degrees, we see some encroachment into the city. At 2 degrees, a little bit more. 3 degrees, we see a lot of the port area underwater. and at 5 degrees, quite a bit of Dublin is submerged. All of the above, from sea level rises to wildfires to increased storms, would be very valid answers to give to the question of what are the worst effects of climate change. But in fact, if you look across all of humanity over the next century, the biggest threat to our well-being comes from a much more mundane source: sleep. We all feel how much more difficult it is to sleep during the heat waves this summer, and recent studies have predicted that it's likely to get much worse over the coming decades as global temperatures rise. Lack of sleep is linked to all manner of diseases, such as increased risk of heart disease, strokes, and mental illnesses. So the worst effect of climate change may actually be from the lack of sleep, rather than any of the calamities we usually think of when we consider climate change. So moving on then to our second major trend, inflation. Following the unprecedented stoppage to the global economy in 2020, we experienced a large burst of economic growth in early 2021 and on into early 2022. Add in the impact of the war in Ukraine, sky-high gas and oil prices, we have a recipe for the biggest burst in inflation since the 1970s. As you can see on this chart here, inflation has been relatively low for the last 40 years, but is rising again back up to the levels that we've seen in the 1970s. And bonds have had a fantastic run over the past 20 years or so, gaining by over 200% in the US and similar level in Europe, but are now suffering a once-in-a-generation fall this year as inflation and consequent interest rate rises affect bondholders. Bonds have been fueled by a 40-year downward run in interest rates, but that excellent run looks to be at an end as interest rates are now on the rise as inflation takes hold. That is not to say that bonds may not have pockets of good performance over the coming years, but the long continuous gains of 5% plus per annum for bonds over the past 40 years, driven by ever lower interest rates, appear to be behind us. And then looking at the third major trend, economic growth. Economic growth around the world has been on a declining trend for the past 70 years, been very strong in the post-Second World War period and in the 1950s, but has been declining ever since. Lower growth, spurred by 4 structural factors, has been woven into the fabric of our economy, and so is likely a very enduring headwind for economic growth for some time to come. Population growth has been steadily slowing since the 1960s. And while less population growth is a good thing for the planet, lower population growth leads to less economic growth. Productivity growth, a major factor in global growth, is declining over time. Workers are becoming more productive all the time, but at a slower pace than in the past. This is a drag on growth. Deglobalization then also is a rewind of what's happened in the last 40 years or so, where companies have located their businesses in the most opportune areas and then helped economic growth. But that is now unwinding post the war in Ukraine and COVID. And finally, but probably most significantly, total debt around the world has climbed to huge levels. In the developed world, it's now at $150 trillion. And when you add in emerging markets, it's $275 trillion. Total debt is now 3 times larger than it was 40 years ago, making the debt burden that much harder to bear. So this crushing debt means that even low levels of interest rates can sharply slow economic growth, and it does that in 3 different ways. First, borrowers will pay higher interest rates on their existing debts. Secondly, financial markets are now 4 times larger versus the global economy than they were 40 years ago. So lower interest rates have helped push equity markets and bond markets to very high and probably unsustainable levels. So higher interest rates will mean possible chaos for markets that have become addicted to low interest rates. And then some countries, think Italy or Japan, will really struggle as interest rates rise because of their very high debt pile, and that could add further instability into markets as well. So all of that means that even low interest rates could add up to quite a bit of instability and a real drag on global economic growth. So what areas are we avoiding within our client investment portfolios? Even with modest rises in interest rates over the coming years, Deposit rates after inflation are likely to remain highly negative for the foreseeable future. So we are avoiding cash deposits within investments where possible. Even if inflation comes under control in the coming months, it may impact already battered bond values and may continue to do so as well. So we're continuing to avoid bond investments, a stance that has served us very well so far this year. So how should investors be positioned? Well, we believe that renewable energy infrastructure, forestry, and companies that are focused on the energy transition will do well from this climate transition. Again, renewable energy infrastructure and infrastructure in general will do very well from inflation, as will equities and property, though the latter two at much lower levels of inflation, because higher levels of inflation may destabilize them. And to address enduring low economic growth, infrastructure in particular with its high dividend will shine, and property, which pays good dividends as well, will be helpful. Equities with good growth prospects, such as those focused on climate change or climate transition, will also do well. So what are we doing at Cantor Fitzgerald Ireland to keep ahead of these trends? Well, we have a number of products in our pipeline to give investors the toolkit that they need to address each of the challenges that we discussed. We are in the process of launching our own infrastructure fund. It will target a strong dividend and additional capital growth. It will build on our excellent 12-year track record in infrastructure investment and will also crucially provide a linkage to inflation. However, its key differentiator will be that it will have net negative carbon emissions. So carbon emissions will actually be less than zero. And it does this by having assets that absorb carbon from the atmosphere. And we think this will have a very wide appeal for many investors in the years to come, particularly those looking to green their investment portfolios or offset carbon emissions elsewhere. So in conclusion, inflation may be higher than it has been in the last decade over the coming years. And even so, interest rates are likely to remain lower than they have been in the past. And particularly, they are likely to remain lower than inflation. Secondly, infrastructure provides a very solid yield and some capital appreciation as well, so it's likely to shine in the coming years. And crucially, it also provides some linkage to inflation. The climate transition will require huge investment and will provide opportunities for investors who remain aware of this particular trend. And all of the products that we provide to address these particular areas will also come with strong positive impact on the world as well. Thanks very much for watching, and if you'd like to get further information, please contact your Cantor Fitzgerald broker.